Let's talk about what types of financing are available. Once you're prepared to take the next steps in seeking out financing, you need to figure out your first, second, and third choices for your financing partner. It's easy enough to start with friends and family at first, but at a certain point, those avenues dry up and you probably don't want to have to be held accountable to your father-in-law anyway, depending on how hands-off they are. Here are some common financing options for small business owners and a quick summary about each option. SBA Loans. These are business loans guaranteed by the Small Business Administration. These loans are great for low-interest loans for startups and businesses trying to expand without traditional lending options. Term loans. These are a lump sum of capital that gets paid back in regular repayments at a fixed interest rate. Business lines of credit. Loan amounts borrowed but not necessarily spent. So the borrower repays only the amount they withdrew with interest. For example, you can be approved for a $50,000 line of credit but only need to take $6,000. You can leave the other $44,000 with the bank and you can always draw more money if you need to. As long as you pay back the money borrowed, you can keep borrowing and paying back the line of credit as needed. This is popular for seasonal businesses who need cash to float them during off seasons. Invoice financing. Business owners receive an advance of capital in exchange for their unpaid invoices. Startup business loans. These are standard loans. However, they have fewer requirements based on business history. Equipment financing provides capital specifically for the purpose of purchasing new or used equipment. Short-term business loans. These are used for managing cash flow, handling emergencies, and any other unexpected opportunities. Merchant cash advances. Financing company provides you with an advance of capital in exchange for a percentage of your daily credit card or debit card sales plus a fee. So they loan you money and then with every sale you make, you pay a percentage of that sale back to the loan company. In general, any of these financing options are available at traditional and financial institutions such as banks and credit unions. However, financial organizations outside of banks are also able to help small businesses with financing and fewer restrictions. However, be mindful that fewer restrictions likely means higher interest rates. Loans can be used to finance a small business and require the borrower to agree to specific repayment terms. Some small business owners take out personal loans, or if they are homeowners, home equity loans, because sometimes these interest rates can be lower. Others use small business loans from banks or credit unions, which often require at least 2 years of operating history, financial statements, and tax returns for both the business and the principal owners. Banks will look at financial ratios of the business, such as EBITDA, which is your earnings before interest, taxes, depreciation, and amortization, and debt to equity before offering lines of credit. Requiring financial statements going back 2 to 3 years often means a bank will not issue loans for new startups. The Small Business Administration, the SBA, backs loans from its lending partners, which means it sets guidelines and acts as the guarantor for loans, assuming some of the risk for newer businesses. Now, besides commercial bank loans, non-bank lenders such as peer-to-peer lending programs, microlenders, and online-only lenders may also provide small business financing. However, keep in mind that all loans aren't made equal. Understand your monthly payment, how much is principal, how much is interest, and how long you'll be paying back the loan. After the SBA, banks are still able to offer the lowest interest rate. So while microlenders and companies like PayPal and QuickBooks might offer you money quickly, with limited inquiry into your financials, the trade-off is that the amount you'll end up paying them in interest might be equal to half of the amount you borrowed. So borrow $20K, pay back $30K total after a year. That's crazy. Grants might be useful to you depending on the kind of business you're starting. Some private foundations, companies, and crowdfunding websites provide grants ranging from micro grants of under $100 up to thousands of dollars. All grants have eligibility requirements, so make sure that you read the requirements carefully before you waste time applying. For example, some grants are only for jewelry businesses or businesses owned by veterans, and many grants are exclusively for nonprofit businesses. Make sure you research who is providing the money and watch out for scams. You should not have to pay money to find out if you're eligible for a grant. Venture capital is popular these days. Everyone knows someone who's a venture capitalist, right? This is capital from individuals, pension plans, private foundations, and other sources that are put into funds at venture capital and private equity firms. Then, once that money is all lumped together, that money is invested in businesses in exchange for part ownership. Venture capital firms usually specialize in certain industries and are looking for businesses that can provide high returns on their investment, either by being acquired or by going public. Because of this, venture capital financing tends to focus on newer companies in innovative industries or products, often in high-tech fields that have patent protection. Crowdfunding has grown in popularity recently. Crowdfunding is using an online platform to collect small amounts of money from many individuals in order to raise the amount required. Crowdfunding can take the form of a donation, a reward, or equity. Donation crowdfunding is often used by charities or nonprofits to raise money. GoFundMe is one of the biggest in the game here. People who contribute money in a rewards-based crowdfunding model receive a reward usually tied to their level of giving. Think about Kickstarter. The more money you give, the more t-shirts or swag you receive, or the quicker you'll get their new product. Equity-based crowdfunding, in which business owners can receive money from investors in exchange for part ownership, was made possible by the 2016 Jobs Act. Now, these are micro amounts with micro equity, but there are a few companies that facilitate this, and Republic is one that comes to mind for me. You can invest as much as $100 in a company that's trying to raise money, in the hopes that your investment pays off 100 times over. Government funding is another option to consider. State and local governments offer various types of financing that range from grants to loans and scholarships, and even tax incentives. Websites like USA.gov or SBA.gov can help you find out about federal loans available to you. USA.gov can also help with programs based on your state and can help you narrow down your search. There are so many options available, but ultimately, it comes down to where your business is, what type of history it has, and how cheap you can get debt. It shouldn't be a race to obtain debt, because then you'll make a rash decision that will be emotional and probably cost you money. It would be wise to start the process of obtaining financing or debt before you need it, so that you can shop around, get the cheapest rates, the best repayment terms, and the most convenient option for you and your business. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.